This is CC. Welcome to the Orbit. It is Tuesday, February 13th. It is a CPI morning, and the market is not reacting well. We had a hotter than expected CPI print. We are down about 1.5%. We are looking at the SPY right now. That is well above what options were pricing. Options were pricing about a 0.6% expected move into the CPI. That was higher vol than what we had been seeing lately, but still very historically low. So this definitely caught the market off sides a little bit. The expected move was about 0.6%. We're looking at the SPY. You can see where this gap fill, where this takes us back down to, these are basically levels that we saw at the beginning of February before we saw this attempted breakout, above 500 in the SPY, above 5,000 in the SPX, and we are back below that. The expected move, let's zoom in here for 1 week. The expected move for the rest of the day is about 0.4%. That is about what you would be seeing for the entire day. We are now about an hour into the trading day, so that shows you how pumped vol is for the rest of the day. It's about 0.4% expected move, 23 vol. That was only about 15 or 16 going into the CPI. So that jumped. Let's see what it did for if it took the rest of the days up with it. And it has a little bit. This vol was about 13 and some were even 12. And now we're looking at the next couple of SPY expiries up around 15 and 14. We come out here then actually at the end of Feb, that's when we start seeing those really low 12, 11. And this is puts. So let's look at that actually real quickly. And you have a day where, the story may have just changed. I don't think there was anyone left thinking, or at least not many people thinking, that the Fed was going to lower rates in March. I think most people had sort of pushed that back to May. But if you saw a couple of hotter than expected stubborn inflation numbers in a row, that keeps pushing out those Fed rate cuts out farther and further. Potentially mean some sort of mini correction at least, or some sort of pullback or an end to this momentum. It could, it might not. The market has shaken off a lot of those types of stories over the last couple of months. But in that case, and if you have a portfolio, all we have to do is zoom out here. You see this run we've had, right, since the fall, and Qs and some of the other indices look even steeper. And obviously some of these individual stocks have just begun to rip higher, a lot of them. If you are looking for protection, it's not like you missed the boat because there's a little bit of near-term vol spike today, and the market has kind of pulled back a 1.5%. You have not missed anything. Volatility is still historically low. Just look at a put spread let's go out to the end of March, and we've got a 15 wide. This is risking about 400 to make 1,200. And the break even is only just below 490. So, to put that in perspective, the SPY is down $7 today. This trade breaks even not even $5 lower. And this would protect you down to 478. You can, of course, take that lower. Let's go down and let's make this 20 wide and see what those prices are. Again, this is risking less than 500 to make up to 1,500 or so. Possibly even better, and you can keep messing with this. You can take this down. Let's say we wanted to go 25 lower, catch these lows right here. Now we're just about 500 and change up to 2,000. So you kind of see this at the money vol is so low, and there is a little bit of skew as you come down here. You will see these puts get to be higher and higher vol as you get lower. So something that's at the money or near the money, selling a farther out of the money put, you're going to get very, very interesting risk reward for hedges, for outright bearish bets. So, and the same will be true in the Qs. And so if you are sitting on a bunch of gains in your portfolio, you are long some of these stocks, look at the SPY put spreads out to the end of March, maybe out into April. Look at those, look at the same thing in the Qs. If you're heavy into tech, or if you have a lot of small caps, look at this in IWM. And then also kind of look at these in some of these individual names. The low vol across the board might have similar setups in even individual names, especially ones that have already reported. You think about those big mega cap tech stocks that have already reported, their vol is going to be very low post earnings. So for those that are, a little worried about the news this morning, that this could turn into a bit of a pullback in the market. They're sitting on some gains out a month or two, and start looking at some of these put spreads and see if they could be a fit for that type of hedge.